busy weekend. We all know how weekends can be. Thank you so much for accepting to facilitate this session. Over to you now.
All right, thank you very much, and it's a pleasure to be here. Thank you for, I see it as an opportunity or a privilege to be able to share knowledge with you all, and I'll just share my screen in a few minutes and I will explain, I'll give you an overview of the class today. I'm looking for where to share. Give me a sec. I'm not sure if I have sharing rights because I'm struggling to find where. Okay, now I have it. Thanks.
Yeah.
All right, can you all see my screen?
Yes, I can confirm that your screen is showing. Would you want to put it on full screen mode?
On presentation mode, yeah.
Yeah.
Okay, so thank you. Thanks again for having me. In terms of just setting the tone for this, I'll call it a lecture, but I like to see it more as a conversation. So feel free to stop me at any time to ask questions. Now the overview, in very simple, in broad strokes, we'll be covering two main areas, and I'll be adding a third area just to support your analysis. So the first area is financial statement analysis, ratio analysis. Forecasting is the next, and then sensitivity. But I won't be taking it necessarily in this order. I think I'll like to start with the slightly more complex aspect, which is forecasting. And then as a subset of that, I will talk about ratio analysis and sensitivity analysis. Now just get into the meat of the matter, right? Now, what is forecasting? I was going to ask this question before sharing my screen, but I think I've gotten ahead of myself. But for the participants, is anybody familiar with forecasting? I'm trying to see how I can see hands. Is anybody's hand up? Or do they have rights to be able to ask questions? Let me start from there.
Yes, they have, but no hand is up and there is no feedback in the chat box. So guys, please feel free to either use the lift hand option or respond to the facilitator in the chat box.
Okay, I'm just putting up my chats on the side so at least I can see any messages if they come through. Okay, so I'll go straight ahead since nobody has a question or response. But forecasting, as the name implies, means that you're trying to estimate what the future outcome will be, right? Now the approach that the objective from a financial standpoint is to be able to estimate what a business or a project's performance would be like in the future. The future period would always be stipulated, whether it's a year, 2 years, 3 years, 4 years, or 5 years from a certain starting point, right? Now, there are two approaches when you are forecasting or developing financial projections. By the way, I might use financial projections as a substitute for forecasting, but please don't get confused. They're one and the same, at least in this context. Forecasting and financial projections are one and the same. Now, there are two approaches when you're coming up with your financial projections or when you're forecasting. One, the first approach is a bottom-up approach, and then the second is called the top-down approach. Now, the bottom-up approach essentially involves looking at the intrinsic drivers of a business to then estimate what the company's financial performance is based on the three income statements. So income statement, balance sheet, and cash flow statement, right? So this approach requires you to have a fundamental understanding of the business model, right? And the elements of the business models and the drivers of value for that business, because that's what you use as the basis, and then add them all together to be able to come out, determine what the financial output would look like, right? Now, it's a more granular approach because you are essentially building several blocks up to form the whole building, right? One advantage of a bottom-up approach is that it's more robust and therefore more realistic. So more often than not, a bottom-up financial projection will be closer to reality compared to a top-down approach. The second advantage is that it's easier to determine how certain strategic initiatives or actions would impact the business, right? And also help you to quantify that impact as well. Okay, I can see there's some charts here. So Uchena says, forecasting is trying to predict what will happen in future. Exactly. So you're right, Uchena, if you can hear me. Now, going back to the bottom-up approach, one disadvantage of the bottom-up approach is that it takes a longer time to build and is often more complex. So, and I'll show you one sample model. Unfortunately, we don't have enough time for us to build or work through a live case study in this class. But what I'll do is I'll send materials after this class that you can always refer to or go over after this lecture is done. Now, the other disadvantage of the bottom-up approach is that because it's so detailed, it's easy to get lost in the detail, right? So there's so many numbers, there's so many, details in it, and it's easy for you to get lost in it. So another question for you, has anybody seen the annual report for any publicly listed company, whether it's Nestle, a bank, or any other institution? You can just put a yes. Okay, great, thanks. Now, imagine trying to take that financial audited account or financial report, right, for publicly listed companies, and then use the notes of the account to build a financial projection. As most of you that have seen financial audited accounts for publicly listed companies, you see that the notes are very long. The notes are like 10 to 20 pages, if not more, long. So imagine trying to use those notes to build a financial projection for that company. You would immediately note that there's a lot of detail that goes into it, and it's easy for you to get lost in that detail. Now, the third disadvantage of a bottom-up approach is that it requires technical skills. So for the CFA, anybody involved in the CFA Institute, I'm sure you all be raising your eyebrows to say, is that really a disadvantage? Because as CFA, whether candidates or participants in the CFA Institute, technical skills are a must. So, and I'm not trying to suggest otherwise. I think you are, as a CFA member or a participant or a candidate, you are equipped with strong technical skills. But the point is that it requires quite a lot of experience, right, to be able to build a bottom-up approach, bottom-up model that works and that is close to reality. Are there do you have any questions on the bottom-up approach? Is it clear what I've explained on bottom-ups? Okay, I will take the silence as a yes. Now moving to the second approach, which is the top-down approach. The top-down approach essentially focuses more on the macro side of things. So you would look at how, let's say, an industry or an economy is faring, and then use that as a basis to estimate what the company how the company would perform. So how many of you, for instance, have heard of or see research reports that talk about a company's market share? Yes, no, I haven't seen any. Okay, yes, Emmanuel says yes. So, yeah. Okay, Adeyemi has a question. Is bottom-up approach easy to reach financial targets or company objectives? Could you clarify? Maybe you could unmute your mic. I'm not clear on your question. Hi, Adeyemi.
Dr. Adeyemi, yeah, please, you can unmute your mic. I've been able to that from the back end.
Oh, thank you. Good morning.
Good morning.
Good morning, sir.
Thank you, sir. Thank you, CFA, for this. I just want to know whether it's bottom-up approach, starting from the indices and the indicators,
Yes.
whether it's, I'm just trying to compare the two, whether it's help us to, if there is a set target for a company financially, whether which one is better, whether bottom-up or top-down approach.
Okay, so the simple answer is the bottom-up approach will be better where you have a set target. So by set target, I assume you mean KPIs, so key performance indicators, right?
Yes, yes.
Yeah. More often than not, the bottom-up approach would be better because your KPIs would not just be top line numbers, right? So it won't just be, say, generate revenue of X amount, right? Or reduce your cost by X%. There'll be things like win X number of clients, right? And have each client generate an average of X number in revenue or X number in terms of volumes of sales, right? Those KPI numbers that you typically have is usually what you typically use in your bottom-up approach to build your financial model. So it's easier for you to incorporate your KPIs and then use a bottom-up approach to reach your financial target because your financial model would help you establish a path in terms of what you need to do to be able to achieve the goal. Does that make sense?
Thank you, sir. Yeah.
All right.
It is.
Thank you. Okay, thanks for that question. Now moving back to top-down approach. Now, as I was saying that the top-down approach is based on macro, focuses mainly on macros, right? Or industry indicators like market share, right? And then uses that as a basis to estimate or develop projections on how the company will perform. And I'll show you an example of each approach. So this is just to give you like a first introduction as to what those two approaches involve, right? Now, one disadvantage is that one advantage, right, with the top-down approach is that it can be built quickly, right? So it's easy to build those kind of models. You can do it in maybe a few hours or less, right? And then another advantage is that it's easier for less experienced financial modelers to build those models. So if you've not gone through like a financial modeling training, right, a detailed financial modeling training, you might find that a bottom-up approach might be a bit too complex and that a top-down approach will be easier for you to at least start off with. Now, disadvantages of a top-down approach. These include one, it's not robust enough to reflect the company-specific nuances. So it's not robust enough to reflect the intrinsic indicators of performance of a company, right? Another disadvantage is that it's difficult to show cause and effects of certain assumptions. Why? Because the assumptions that drive a top-down approach are more often linear. They are just like straightforward assumptions that just say maybe X amount every year over a period of time. But with the bottom-up approach, you can change certain variables because there are many variables involved. You can alternate the variables over a period of time, which brings us to the point of sensitivity table. But I won't take the sensitivity analysis, pardon me. I won't explain the sensitivity analysis just yet. I'll when we get to that side, I'll provide more details. Now, the third disadvantage is of a top-down approach is that it relies on general rules of thumb, which might not be applicable. So for instance, it's difficult for a top-down approach to accurately predict, once in a lifetime or unusual occurrences. So for instance, a top-down approach so let's look at COVID, for instance, the impact of COVID on the financial performance of companies, right? With a top-down approach, it will have been very difficult for you to use that approach to estimate how a company will perform in the midst of COVID. Why? Because over the last 5 years preceding COVID, there was no similar, such a similar event that happened, right? But with a bottom-up approach, because you can understand how COVID is impacting businesses, whether it's fewer foot traffic because of lockdowns, so customers can't walk into your stores, or supply chain issues because, let's say, there are fewer vessels that are supplying, and so on and so forth. It's easier for you to incorporate those assumptions into the bottom-up model. And then a top-down approach would not be able to incorporate that, so that it will be difficult for you to factor in such once in a lifetime or non-recurring events like COVID. Uchine has a question. Can you give an example of instance of how top or bottom approach prevents reflection of company-specific nuances? You might need to. I get the first part of your question, but let me take a stab at it, and you can tell me whether I address your question appropriately. So one example of how a bottom-up approach would work for a company is, let's look at one scenario to compare and contrast it to, right? So let's look at a company that is about to start business, and the company is into let's look at I'm trying to think of this on the go, so pardon me if I'm stuttering a bit. So let's look at Nestle, for instance. We all know Nestle's products, Milo, Golden Morn, and a few other products, right? Let's assume, let's look at how a bottom-up approach versus a top-down approach would help a company like Nestle to project or to make certain strategic decisions, right? Now, Nestle supplies, let's make a simple assumption that Nestle exports Golden Morn and Milo to neighboring West African countries like Ghana, right? Now, with the COVID lockdown, what happens? The borders are difficult to access, so there are fewer goods going across the border. With a bottom-up approach, one of your KPIs would be things like the volume production capacity for Golden Morn and how much of that production capacity is utilized. Then you also have another assumption around logistics, i.e., how many trucks you would need to move the products across the border or to certain marketplaces for sale, right? Now, in your bottom-up approach, you can easily indicate that, let's say before COVID, there were 100 trucks moving across the border every day, right? With COVID, because of the border control, the number of trucks crossing the border would reduce from 100 to, let's say, 50. Right? It's easy for you to incorporate that assumption into your bottom-up model. And then with that, you can then indicate how that would impact the volume of products that are sold, right? And then by implication, how the volume of products that are sold will impact your revenue, right? With a top-down approach will just look at market share, right? For Nestle. And you to say, for instance, Nestle's market share in the Ghanaian market or in the Nigerian market is, let's say, 10% of cereal products, right? Over the last 5 years. with COVID, right, because there's no precedence for how the company's market share would be impacted by COVID, it would be difficult for you to make a reasonable assumption of what market share figure Nestle would have because of COVID, right? So you can see the difference between factoring in like the number of trucks, the volume of products sold, and how that impact revenue versus just looking at only market share alone and difficulty in factoring in border control issues into your market share. I don't know if that answers your question, Uchina.
Oh yeah, thank you very much. From the explanation, does it mean that when you are dealing with bottom-up approach, like you focus more on the metrics of the company rather than the macro in general, but in that top-down, you give a higher focus on the macros than the company-specific metrics?
Exactly.
Okay.
Exactly.
Thank you very
You're welcome.
very much.
All right, so moving on to the next slide. I'm cautious of time. Now, on this slide, I've just outlined some of the elements of a business model and how that would form some of the drivers for your financial model. So how many of you have heard of business model canvas? Yes, anybody? Okay, I'll take it that nobody has heard of a business model canvas. But essentially, business model, okay, Blessing has. A business model canvas, okay, Daniel also has, so great. A business model canvas essentially is just an overview of the elements of a business model. Gloria has a question. Hi, Moya, you actually have up to 2 hours. Okay, great. Yeah, but 2 hours can fly by in no time, and I have quite a number of slides to get through, but noted. So a business model canvas essentially is a summary of all the elements or key elements that drive a company's business model. So it covers things around partnerships, key activities, customer segments, value proposition, customer channels, and then things like cost and revenue drivers, right? So on this slide, on the left-hand side, where you have elements of a business model, I've kind of summarized some of those elements of the business model canvas for you, just to give you an idea of what would be considered, right? So you have things like customer value proposition, right? What segments does the company serve? How is the product or service priced? What is the demand profile, right? You also have things like go-to-market strategy, things like what is the customer acquisition cost? What channels are utilized in reaching customers? How is demand generated? You also have things around technology and operations management, which are what activities are conducted to produce products or provide services, what activities are in-sourced, pardon the spelling error, that the S is a D, versus what are outsourced, right? And then how is value created? And then the profit formula, what is the contribution margin? What is the addressable, obtainable market? What are the variable and fixed costs? What are the expected cash flows? Princess, you have a question? Oh, you can't see the slide. Can everybody see my slide, or it's just Princess?
Your slides are visible.
Okay, Abiodi can see it. Okay, Daniel can also see it. Okay, so Princess, I think you need to check how you've signed in. I'm not sure why you can't see it, but everybody else can. So I'll keep moving on. Now, all the elements of the business model essentially form the elements of your financial projections, right? So your revenue drivers, I already mentioned things like your price per unit, the number of units produced, production capacity, capacity utilization. All those are examples of revenue drivers, right? And then operating cost drivers, things like number of staff, which will influence things like staff costs, number of branches, which will influence things like overhead costs and electricity bills, right? Those are examples of operating costs. Capital expenditures, things like number of equipment purchased, any upgrade to equipment, maintenance costs for equipment, all those are drivers of capital expenditures. Working capital will include things like inventory, warehouse space, etc., right? And then funding is just like your equity versus debt funding, right? So this is just a quick overview to see how in a bottom-up approach, right, how the elements of your business model essentially are related to elements of your financial model, right? Are there any questions on this slide before I move on? Okay, I'll take the silence as a no. Moving on. Oops, sorry. Now, I want to just quickly take you through elements of a financial statement, but out of curiosity, how many of you are familiar with the financial statement? So the income statement, balance sheets, and cash flow statements. Can you just indicate maybe in the chat by saying yes? Okay, Uche, Latif, Emmanuel, Precious. Okay, I take it that everybody's familiar with the overview of a financial statement, so I won't spend too much time here. So this is a quick or summary overview of a financial statement. So you have, for a business would acquire assets, and in acquiring the assets is to finance that acquisition using equity or liabilities. The assets produces income, but it also costs you money to maintain those assets, right? So that's the income and expense. And then the income generates cash inflows, your expenses are cash outflows. From this overview, you would notice something obvious that you might, you're familiar with. The first part that covers your assets, equity, and liabilities essentially is your balance sheet position. Everything that covers your income and expense is your income statement. And everything that covers your cash inflows and cash outflows is your cash flow statement. So I take it that everybody's familiar with this overview. So I'll move on real quick. Now, elements of your balance sheet. Again, I won't spend too much time. On your asset side, you have your current assets and non-current assets, right? Or your long-term assets. And these are financed either by equity, and your equity includes share capital, share premium, reserves, and retained earnings. And on your liabilities, they include current and non-current liabilities or long-term liabilities, right? Again, these are things that you're familiar with. In terms of your income statement, again, on your income side, common income lines are revenue from core operations, income from non-operating activities or non-core operating activities, interest income. And then on expenses, you have direct costs, operating expenses, interest expenses, and taxes. Now, on your cash flow side, again, I'm sure you're familiar with all of this. Your cash inflows include revenues or earnings, investments, investment incomes, debt drawdowns, dividend received, sale of assets, interest income, etc. For your cash outflows, you have direct costs, operating expenses, interest expenses, taxes, etc. Again, I won't spend too much time here because you're all familiar with it. Now, some of the fundamentals when you're building your financial projections, just keep in mind these three words: reliability, accuracy, and how verifiable the data is, right? Reliability essentially has to do with how the logic is consistent over a period of time, right? So the reliability of the logic essentially means if you apply that same logic, 2 years, 3 years, 4 years ago, there's some level of consistency in terms of how that logic works. Now, the logic would include things like production capacity. For instance, this is an example: production capacity versus production utilization rates, right? That is an example of a logical way of determining how many units are produced and then how much revenue a company will generate, right? For a manufacturing company, that is a reliable way to estimate the company's profits or earnings or revenue rather, because that is a logic that is consistent no matter how far back you look at the company's history, right? In terms of accuracy means, and for those of you that are familiar with statistics, it's just how close to reality the output or the outcome is from your financial projections. So it's a case of how realistic they are, if I could use that word. Verifiable just means being able to source some of the assumptions that you've used. So for some of you're familiar with research, right? Research work. So things like macroeconomic data reported by the CBN or money market indicators reported by FMDQ or CBN or any other similar website. Those are publicly accessible sites that provide primary information that you can use in your projections. So just keep these in mind whenever you're building your projections. You need to make sure that the logic you use when you're building your projection, whether it's bottom-up or top-down approach, is reliable, right? Next is that your results are accurate, i.e., they are close to the level of variance in terms of your projections vis-a-vis the actual results when they happen. The margin of error is minimal, usually below 10%. And then verifiable just means that whatever assumptions you've used, you can refer the reader or whoever will be using the model to public sources where you got information that you use as assumptions for your projections, right? Now here's a quick overview of the process for building a financial model. Sorry, I just realized the arrows are missing, but I'll explain how it works. So now this process is centered more towards a bottom-up approach. And I'm focusing more on the bottom-up approach for now because I think that's the more detailed or complex approach. The top-down approach is very easy for you to build, and you see how I'll show you shortly how that works. Give me a second, please. Maybe before I go into the process of building a financial model, let me just give you a quick overview of how a bottom-up approach model would look like versus a top-down approach model. Give me a second. Let me just change my screens and then you see what I'm talking about. Can you all see my screen?
Yes, I can.
Okay, great. Now, in this Excel sheet, I have an Excel sheet up. In this Excel sheet, I have two sets of tabs. You see with the parts that aren't, the tabs that aren't highlighted in orange, those are top-down approach models, right? That's the top-down approach model. And I'll show you how that works. And then the part in orange is the bottom-up approach model. Now, this is an income statement projection for a pension company. Hopefully this is not too complex for you to understand what I'm talking about, but please, if I'm losing you, just call me back or draw my attention to it so I can slow down a bit. Now, with the top-down approach model, remember I said it focuses on things like macroeconomic indicators, like market share or growth of an industry, right? Now, if you look at this model, and you can look at the formula bar above, you see how I've projected the fee income or revenue for this pension company. What I've just done is to grow it by 30% or 40% in different years, right? This is a prime example of a top-down model. This 30% model, going back to what I said earlier about reliable, accurate, and verifiable. Now, the reliability, you would notice that the let's look at COVID, for instance. And by the way, COVID happened in 2020, right? We all know that assuming a 30% growth rate, simply because in the previous year, historically, the company grew by 33.5%. That's the fee income grew by 33.5%, right? Me assuming 30% seems logical because in the previous year, the company achieved even more in the previous year. But for those of us that know what happened in COVID 2020, we know that a 30% growth rate, a 30% growth rate might not have been realistic. Why? Because the impact of COVID on this pension company. And you might ask, how would COVID impact the pension fund administrator, pension fund company? In a case, a pension fund makes money or fee income from essentially investing pension contributions from contributors, right? Now, those investments earn a fixed fee, right? But it's dependent on the quantum of contributions made and also level of return generated on those investments. Because of COVID, the number of layoffs, right? So a lot of people lost their jobs around COVID. So there's a high probability that the level of contribution in 2020 will have dipped, i.e. will have reduced compared to the previous year, simply because there are fewer people that are earning income and contributing to their pension fund. The second thing is we all know that around that 2020, right, after a number of crises or civil unrest in Nigeria, a number of people relocated to other countries, whether it's Canada, UK, Australia, wherever, right? A lot of people relocated, meaning that people that were previously earning income in Nigeria and contributing to their pension funds, they relocated, meaning that they were no longer contributing. And in some cases, some of these people that relocated drew down on their pensions simply because there's a pension regulation that allows you to withdraw from your pension account when you're unemployed, right? So people that are unemployed have that benefit of if you are unemployed for a certain period of time, you have the benefit of being able to withdraw from your pension account. So essentially, I've given you examples of how this 30% as growth rate of fee income might be unrealistic if you then look at the realities of COVID and what happened during COVID, right? So do you have any questions before I move on? No, yes, I'll take the silence as a no. So you see with each line I have here, right? With each line I have here, the income lines are simply based on a simple growth rate, right? And the expenses, I've done it as a ratio of your income, right? So I've just said admin expenses are 60% of fee income, right? Again, this assumption of 60% ratio of admin expenses to fee income might also be unrealistic because if you recall, during COVID, a lot of businesses, people were not allowed to go into companies, right? What I mean is there was a lockdown, so people were forced to work from home, right? The admin expenses would include things like overheads, electricity bill, water bill, the cost of entertainment, things like tea, biscuits, water, dispenser water, and so on. All of those things will have dropped simply because there are fewer employees coming physically into the office, right? So assuming a 60% admin expense to fee income ratio might also have been unrealistic, right? But the basis of my 60% is simply what the company did in the previous year. It was around 70% in the previous year and then around 82% in 2018. So 60% might not be realistic if you factor in how business operations changed significantly during COVID, right? But again, this is just to give you an idea of how a top-down approach model would look like and how some of the assumptions are not really reflecting the realities on ground. Does this make sense? Yes, no, any questions before I move to the example of bottom-up approach? Okay, great. Blessing says yes, Uche says yes. I won't go into the balance sheet and cash flow statement, but this essentially is just to give you an idea, sorry. This is just to give you an idea of how a bottom-up approach model would work, but essentially it's a similar way, you grow certain asset lines and certain liability lines, but again, the assumptions on growth rates and the ratios might not be realistic because you've not factored in specific nuances in whether it's the macro environment or that are specific to the company. Now let's move on to bottom-up approach, an example of a bottom-up approach. This is the same company. So you notice that the income statement, historical income statements is the same, 577 in 2019, same 577 in 2019 right here. But this is a bottom-up approach, and you notice that the figures are markedly different in terms of the fee income, right? Significantly different. Now, here I have a working sheet that shows how my fee income is projected. So it's not just a simple growth rate. And I'll show you at a high level what those workings look like, right? So this is the fee income line. This is my note on fee income line. So this entire area that I'm highlighting. Let me just scroll down further. So all the calculations I'm highlighting, if you can see this, oops. All the calculations I just highlighted are calculations just to project the fee income line alone, right? So you can see all the level of detail that goes into projecting just the fee income line, right? Now this takes me back to what I said earlier about some of the shortcomings of bottom-up approach, right? So if you remember, I said a bottom-up approach is very detailed, right? On one hand, it helps you to be able to factor in certain more detail into your projections and make it more realistic. But at the same time, it's complex and it's easy for you to get lost in the detail. And you can see the level of detail that goes into projecting the same fee and commission line, fee income line, right? Now here, I've projected the fee income line as the sum of administrative expenses and management fees, right? Now, management fees for this pension fund company is made up of management fees on RSA accounts, retiree accounts, legacy accounts, right? And then total administrative fees are a function of admin fees on RSA accounts, retiree accounts, right? And then you can see how I projected the management fee on RSA accounts is a function of the net asset value of an accounting unit. Value of an accounting unit, which is like the price of an accounting unit, number of RSA accounts, etc. right down here. Now, this is how I projected this line. It's a similar level of logic that goes into projecting all the other lines, right? Now, in a situation where I'm trying to consider or factor in the impact of COVID, sorry, I just realized that the dates are a bit wonky. Yeah, sorry for the dates confusion, but anyways, so in 2020, right, let's say I'm building these projections in, let's say, February 2020, and I've already started seeing the impact of COVID because COVID started around November or December of 2019, right? That's why it's called COVID-19, right? It started in 2019. In Africa and Nigeria, we started to see the impact in, let's say, around April 2020. But globally, you could already see how COVID was affecting companies and businesses in different countries. So here, I can easily make an assumption to say, instead of the value of an accounting unit of RSAs increasing, right, or the number of RSA accounts increasing from 213 RSA accounts to 255 RSA accounts, I can simply adjust this assumption to say, look, I assume that there'll be a dip in the number of RSA accounts, right? And if you notice, my projections already updates. right? So I simply changed one assumption and all the figures changed. So let me do that again for people that didn't see that. So keep an eye on management fee, total management fee. The total management fee here is 687 million naira, right? And this is assuming 255 RSA account holders. What if I now say, because of the impact of COVID, I assume that the number of RSA accounts will drop by 5%, right? So this number drops by 5%. You can already see the impact of that change in your assumption on your management fees. That means you're expecting a slightly lower management fee. Now, if you say, okay, 5% might not be, might not, is too conservative. Let's use a more aggressive number. Let's say 20%, or let's say 20% drop in RSA accounts. And similarly, let's assume, sorry, I'm changing things too fast. Oops. Sorry. So let's also assume that the value of the RSA account, or the unit of an RSA account, also dropped 20%. Or let's use 30% here, right? The point is, you can already factor in specific. It's easier for you to factor in certain impacts of COVID into a bottom-up approach because there's more detail. So I can say, how would COVID impact the value of RSA, of a single unit of RSA account units, right? I can say, okay, I expect that the value of a single unit of RSA account to drop. Why? Because there's a general recession. There's a global recession. And what that means is that a lot of investors, or the value of assets or investment instruments, whether it's bonds or equity markets, are dipping, right? Meaning that the value, and because the value of RSA accounts are closely correlated or directly derived from the value of the underlying investments that those accounts are made into, right? If equity market dips, if the bond market dips, then the value of an RSA account would also dip, right? So I've assumed a 30% dip here in the value of an RSA account. I've also assumed that, a number of the contributors under the RSA scheme would leave the country, right? Or they will be unemployed so that they won't have money to contribute, or that they will even withdraw from their RSA investments. They will withdraw from the RSA account. So let's put a figure here, right? I assume that 10,000 is withdrawn. You can see with every assumption that I make for 2020, right, in these projections, you can see how you can already see the impact of it on the management fees. So the management fees started out at 680 something million naira. But by the time I updated those assumptions to reflect the realities of COVID, I can already see that I'm expecting lower management fees of 430, right? Compared to the top-down approach, where I'm simply assuming that, in previous years, the company has done 30% growth rate in revenue. Therefore, let's even be conservative to say 30% growth rate is only achieved. My fee income is 750. Compared to this, in the top-down approach, compared to a bottom-up approach where I'm assuming my fee income will only be 662, right? Because I'm expecting a dip in management fees from RSA accounts. I don't know if this gives you a feel of how some of the advantages and disadvantages of bottom-up versus top-down approach that I mentioned earlier. Yes, no, any questions? Okay, Blessing says yes, it does. Latif says yes, it does. Okay, great. I'm going to switch back to the presentation now. Now, I'm going to just give you a high-level process of building a financial model, but using a bottom-up approach, right? Now, the first starting point for building a bottom-up approach model is to identify and analyze the key business drivers, right? Now you might ask, what are key business drivers? Some of you have already highlighted that before. I think it was Uche and Ade, Adeyemi, that mentioned things like company metrics, KPIs, I forget the other term the other person used, but essentially that gives you an idea of what I refer to as business drivers, right? So those are the business drivers that you need to first understand. What metrics, what KPIs are relevant to this company, and then how do they add up to then, how do they link up to the different income statement, balance sheet line items, right? Next step, so if you can see my cursor, it's going from top, down, up, and that way like that, right? So it's like a snake movement, not left to right. So you first analyze or identify the business drivers. Next, you qualify strategic initiatives and assess the impact on business drivers. Sorry, the text here is too big. Let me quickly reduce that. Then you determine relevant economic, industry, and company-specific assumptions based on facts from steps 1 and 2 above, right? So these are the first 3 steps. Next step is that you project your income statement, right? Then you project your balance sheet, project your cash flow statement. You conduct a ratio analysis, you conduct your sanity checks, and I'll explain what the sanity check is, and then you conduct your scenario analysis. So at a high level, this is the process, right? I deliberately skipped some detailed aspects of each node because I assume that a lot of you this is your first time learning about financial projections and forecasting, right? So I don't want to inundate you with too much information at once. Now let's move on to the next slide. For your income statements, again, I think a good starting point whenever you're building projections is to just pick up the audited account for the company. That way you have all the relevant line items for the income statement, as well as the notes to each income statement line. So you can then use that as a basis for, one, determining your business drivers, but also projecting each line item in the income statement, right? So I think this is straightforward. I won't spend too much time on this slide. Then you project your balance sheet. For the balance sheet, I'll take a little second to explain the balance sheet, right? Because I didn't show it in the example that I showed, the Excel sheet that I showed earlier. For the balance sheet, it's important for you to develop your balance sheet schedules. So things like your fixed assets schedule, right? Again, you find this in the notes to the financial statement if you have the audited account. So what you can just do is replicate that fixed asset schedule, right? And then use your own assumptions around depreciation, capital expenditures, disposal of assets to then project what the fixed asset line would look like. Yeah. You can also do the same thing for non-current liabilities. So term loans, if you have the offer letter from the banks or any other financial institution, typically to include what is called an amortization schedule. So to include things around the principal sum, the monthly interest, principal and interest payments, and then the balance at the end of each period, right? So you can use that to project the loans under your non-current liabilities. For current assets, whether it's inventory, payables, etc., you can use what's called receivable days, inventory days, and payable days respectively, right? So your receivable days is just a ratio that calculates, is 365 days divided by your receivable turnover, right? Alternatively, that formula can be defined, and I'm just typing it in for convenience. That formula can be defined as your 365 divided by sales divided by your average receivables balance, right? Yeah. I've typed it in the chat just so you can see it. I'm sure some of you will be familiar with the formula. So you can calculate this ratio for the historical period and then assume that the same ratio would apply in the coming period. You can do it for...
Hi, Moyo.
Yes.
So I think you dropped it in my private chat, so I'm not sure they can
got you. Sorry.
Yes.
Yeah.
I'm not able to copy it. Let's see.
Oh, got you. Everyone. Okay. I think I fiddled with it a little. Give me a second, please.
Okay.
I can't type it. I can't copy it, so I have to.
Okay, I'll just type it out. Maybe you can go ahead. I'll just type it out.
Okay, thanks. So you get the formula shortly. So I'm sure some of you will be familiar with the formula. So you can calculate, you can use that formula. You can either calculate it for the company historically, right? Or look at what the industry average is and then apply the industry average going forward. Yes? Right, so you get the formula shortly. Next, you would calculate your working capital position using the sum of changes in your current assets and change in current liabilities, right? Obviously excluding cash and overdrafts in this calculation. I've hit something. Yeah. Now you develop relevant schedules for equity items such as share capital, retained earnings, etc. I think that's straightforward. And then you add up your assets, add up your liabilities, and add up your shareholders' equity. One important sanity check when you build your balance sheet is to make sure that your total assets, and I'm typing this again in the chat, is equal to your total liabilities plus total equity, right? This is what would make your balance sheet balance. So let me just quickly toggle back to the Excel sheet so you can see what I'm saying. Now, where's the Excel sheet? Okay, I think this is it. Now with this Excel sheet, let's go to the balance sheet. We spent time on the income statement. Now, you notice what I just typed in the chat, right? It's literally this formula. So you just look at the formula bar and the highlighted cells, right? You see that I've calculated as a sanity check the difference between my total assets and the sum of my liabilities and equities, right? Once the result is zero, it means that the balance sheet is balanced, right? So you can see that this balance sheet here for the bottom-up approach is balanced. Now, I have a similar balance sheet, right? And I do the same calculation, and you can see that there's something missing, right? There's something wrong. The result is not zero. Historically, it's zero, but in the projections, it's not zero. That means there's something wrong with my projections, right? So I need to go back and figure out what I've not posted correctly in my balance sheet or my cash flow statement and then correct it, right? But this is just an example of the sanity check that I was referring to in the PowerPoint presentation. Are there any questions before I move on? Yes, no. Okay, I'll take the silence as a no. Now projecting the cash flow statement. So for the cash flow statement, your cash flow from operating activities captures the profit for the year, non-cash incomes and expenditures, changes in cash in your current assets, excluding cash balance, and then there are changes in current liabilities, excluding overdraft, right? And I'll show you how that works. And then your cash flow from investing activities captures your changes in non-current assets. That's your property, plant, and property, plant, and equipment, right? Your fixed assets. So your cash flow from financial activities captures changes in non-current liabilities and equities, right? Now, let me go back to the Excel sheet so you can see what how this slide is relevant. Now, let's look at this slide, your cash flow statement. On the slide, I mentioned that your operating activities captures your profits, over the period, which is this line, profit after tax. It captures non-cash income and expenditure. So this part where you say adjustments, I've adjusted for non-cash interest received, profits, and so on and so forth, right? And then here in the PowerPoint side, I mentioned that it also reflects changes in your current assets, excluding cash, and current liabilities, excluding overdraft. That's this line, right? And I can show you how that is captured. So you see that your operating assets, at least as defined here, is everything under current assets, excluding, it doesn't include cash, right? So you can see in this section, there's no cash in the calculation of current assets, right? And then in the calculation of current liabilities as well, right? Sorry, you see that there's no overdraft in the calculation, right? So this is what I was referring to in that PowerPoint slide. This is how I'll calculate my change in operating assets and then change in operating liabilities, right? Now going back to the cash flow statement. Please, it's important to note that changes in your assets reflects any increase in your assets is a cash outflow, and any decrease in your assets is a cash inflow. For liabilities is opposite. I'll just type that in. Sorry. Yeah. So just remember that when you are doing that. So that's why in my formula here, you notice I have a negative sign in front. It just reflects that any increase in cash in assets is a cash outflow. Are there any questions so far? Please, I need a response this time. I want to make sure I'm not losing you guys. Can you type in the chat or unmute your mic? Okay, Talabi says no question. Okay. Now going back to the presentation. I won't go into much detail here. I think we've done over an hour now, so I need to move a little quicker so I can get to the end of the presentation. You get this material, so you can go through this when you're building your cash flow statement. Now, ratio analysis, there's a separate side on ratio analysis. I'll skip this for now. And then the sanity check. So now going back to this next section in this lecture is on ratio analysis, right? Now, a ratio is a tool used in assessing the financial position or operating performance of the business in a way that makes it comparable. Now, the comparability is either comparable to the company's historical period or comparable to a similar company, right? Now, ratio analysis is expressed as either a percentage, a multiple, and absolute value. So in the slide I have up, these are examples of ratios that would use in a ratio analysis, right? I think this is straightforward enough, so I'll move on real quick. Now, a ratio analysis could be vertical, which is what I just said. It could be intra-company analysis or horizontal trend analysis or benchmarking, right? And I'll explain each of these. So for benchmarking, you're comparing the performance of one company to another, right? Now, look at the benchmarking example is the parts. Just look at company B and company C and look at the dotted lines. around that. Please give me a second. Sorry about that. So yeah, hi Daniel. Yes, you get the slides. You get the slides out of the lecture. So an example of benchmarking is, let's say you're comparing the performance of GT Bank, which let's assume is company B, to let's say a company like Sterling Bank, right? You choose a metric, let's say net profit margin, right? You compare the net profit margin of GT Bank to net profit margin of Sterling Bank. That's an example of benchmarking, right? Because you're comparing one bank to another. For trend analysis, you are essentially comparing the performance of a company, one company, over a period of time, whether it's months, quarters, years. So in a trend analysis, look at company A. Assume company A is, let's say, First Bank. You are comparing, let's say, the same net profit margin in year one in, let's say, 2020, 2021, 2022, right? For the same First Bank to see how the company has performed in those years, right? That's an example of a trend analysis. For intra-company analysis, you're comparing one metric value to a central metric like margin analysis. So an intra-company analysis is, let's assume year one, you're comparing the net profit margin to the gross profit margin, right? Or let's going back to the bank, company B is GT Bank, right? You're comparing the net profit margin to, let's say, the interest income margin or the cost to income ratio rather for the company to say, how did the cost to income ratio impact the net profit margin for GT Bank? That's an example of intra-company analysis. Are there any questions on this slide? Yes, no. You can use the chat box. Or mute your mic, yes. Anybody? Okay, Uche Emmanuel Talabi, no question. Talabi says, is that no, sir? Or Olaoluwa says no question. I like questions, so if you guys are not asking me questions, I'll be worried. So, okay, moving on to the next slide on ratio analysis. So this is an example of some of the ratios that we'd use in analyzed learning company. It will vary by industry, but broadly speaking, they are relatively similar. So there's a set of liquidity ratios. Liquidity ratios just check essentially whether a company has assets, enough assets to be able to cover short-term liabilities, right? So examples of liquidity ratios would be your current ratio, which is your, I believe, your current assets to your current liabilities, right? Your quick ratio, which would be your, I think it's one aspect of your current assets to your liabilities. Then there's absolute liquidity ratio, there's cash ratio. Your cash ratio essentially compares how much cash you have on ground to cover your liabilities, right? There are turnover ratios. Turnover ratios are just essentially expressing your balance sheet line items to your revenue. So an inventory turnover ratio is just saying what is the ratio of your sales or your revenue to inventory, right? And what you're just trying to say is for every 1 naira of inventory I have, how much of sales will I generate on it, right? So that essentially tells you how quickly you can, sell a product and then buy inventory again to sell again, right? The same, essentially, how it just tells you how quickly you can turn around your inventory into sales. There's a similar logic for receivables turnover, capital turnover, asset turnover, net working capital, and cash conversion cycle. Your cash conversion cycle is in some of your receivable days, payable days, and inventory days, right? So, but again, you can Google a lot of these things. They are readily available. You find the ratios readily available online. I'm just giving you an example of or the broad categories of ratios, so that whenever you are doing your ratio analysis, make sure that you calculate liquidity ratios, turnover ratios, operating profitability ratios at a minimum, and then you can calculate some of these other ratios: risk ratios, financial risk ratios, stability ratios, coverage ratios, control ratios. For your operating or profitability ratios, these are essentially expressing certain ratios to your revenue. So your earnings margin or your gross margins, expressing your gross profit to your revenue. Your return on investment is just calculating your net income to your total equity, right? Or invested capital, depending on which one. Or return on equity is net income to equity, and then return on investment is net profit to your invested capital. Sorry, I have a bit of a cold, so I'm sniffling a lot. I hope that's not too much of a problem for you guys. So essentially just refer to this whenever you're trying to understand or determine what ratios to calculate. So I'm going to toggle back to my Excel sheet real quick to show you an example of some of the ratios that I calculated for this pension company. 1 second, please. So you can see here, this is an example of my ratio analysis, right? So I've calculated ratios for this company. Now, my trend analysis would literally just be comparing, let's say 2018, 2019 to 2020, right? So let's look at operating expense margin. My operating expense margin is a function of my admin expenses to gross income, right? For this pension fund company. And this ratio, it was 76.8% in 2018. It declined to 66.5% in 2019 and increased to 72.4% in 2020. And the question might be, why are we seeing that, dip and that decline, right? We are seeing that dip and decline. You will notice that the admin expenses during the same period has increased steadily, consistently over each year, right? And so has the gross income, right? The gross income has also increased, right? But you are seeing a dip in the ratio in 2019 and then an increase in the ratio in 2022. The simple answer is how the rate of change in each of the two variables. The rate of change in the denominator versus the rate of change in the denominator. Sorry, I'm a little under the weather. So I'm just doing a quick calculation so you can see what I'm saying. So you can see the gross income, increased by 32.5%. Meanwhile, the admin expense only increased by 14.8%. It is because this operating expense margin declined because the numerator, the denominator, that's the gross income increased at a faster rate than the numerator. So it caused the ratio to decline. In the next year, it's the reverse. The gross income increased at a slower rate than the admin expenses, hence the ratio increase. Is my explanation clear? Yes, no? Should I take it again? Nobody's responding. And nobody's asking me questions. No questions or no, it's not clear. Oh, it's clear. Olaoluwa says it's clear. Okay. So there are other ratios here. So I explain the trend analysis. So trend analysis is just comparing. Okay, Blessing says if I can take it again. So Blessing and Deborah and anybody else, and Latif and Kabiru. Remember in the slide, I said I wish I could show two slides at the same time. Let me see what I can show two screens. Give me a second. Let me just see what I can. Share my screen. I'm trying to show two things at the same time. I'm trying to see whether I can figure this out. Yeah, I'm struggling to show my entire screen. But let me just, I'll just have to share it slide by slide. So I'm going back to ratio analysis, right? So here, if you guys can see, Blessing, Deborah, Latif, and the others, if you can see the slide I have up, let me know. I was trying to give an example of trend analysis, right? And intra-company analysis. I don't have an example of benchmarking, right? So for trend analysis, I mentioned that it's comparing the performance of a company over a period of time, right? So year 1, year 2, year 3, year 4, or month 1, month 2, month 3, month 4, right? And intra-company analysis is just saying I'm comparing different metrics in the same year, right? So just keep this slide in mind. If you can take a screen grab of this slide, just take it and keep it to one side while I then toggle back to the Excel sheet. Now for the Excel sheet, right? For trend analysis, remember trend analysis is comparing one year to another, right? And I was given an example that my operating expense margin, right? For a trend analysis, I'll compare how my operating expense margin has changed from 2018 to 2020, right? And I said that for the trend analysis operating expense margin, it was 76.8% in 2018, 66.5% in 2019, and 72.4% in 2020, right? And I'm saying we can see a dip. So it decreased from 76.8 to 66.5 in 2019, and then increased in 2020. However, if you look at the figures here that are driving these calculations, right? That's my gross income line, row 14, and my administrative expenses in row 15. If you look at those lines, right? Those lines are increasing in each of the 3 years, right? So the question is, why does the ratio dip in 1 year and then increase in the next year? And my explanation was this. If you look at the rate of change in the gross income versus the rate of change in your admin expenses, that would give you an explanation for the change in the rate, in the ratio, right? So in 2019, the denominator, like that's the bottom part of the ratio, was decreasing faster, or increasing faster, pardon me, was increasing faster than the numerator. Right? Right? So the numerator changed at 14.8%, but the denominator changed at 32.5%. Because the rate of change of the denominator is higher or faster than the rate of change of the numerator, the ratio dipped, right? And then it was the inverse in the next year, in 2020. The denominator increased at a slower rate than the numerator, hence the ratio increased, right? I hope this is now clear. Deborah, Blessing.
Yes, please.
All right, great, thanks. Okay, going back to the presentation, I have 30 minutes left. Okay, so I'm going to skip this side. This is not for my own training. So sensitivity analysis. The sensitivity analysis, simply put, is just the objective of sensitivity analysis is to see how changing certain variables, right, would impact your projections, right? And to do that, you use what in Excel, there's a function called sensitivity tables, right? The two forms of sensitivity tables, there's the single variable sensitivity table and dual variable sensitivity table, right? And I'll explain. The last part has to do with scenario analysis. That's good. Okay. So for single variable sensitivity table, you are changing one variable and then seeing how it will impact one outcome. Sorry, I've used a valuation variable here because typically you use your sensitivity tables on valuation metrics, right? But valuation is not under my own lecture series. Someone else will take you on valuation, but I'm sure they will also cover, sensitivity tables. But this is just to give you an introductory look into what sensitivity analysis looks like and what it entails. So you're just seeing how changing one variable would impact the outcome. Now let me quickly take you back to the Excel sheet to give you an example, right? So let's look at let me go to my workings. Right? In my workings, right, you notice that all these parts highlighted in blue are variables, right? There are over 7 variables that I use to determine my revenue, right? And each of those variables can change at the same time, right? But let's say I want to see how changing one of these variables would impact my revenue projections. So let's say I want to see how the growth rate of the value of RC accounts would impact the revenue figure. Let's use a single variable sensitivity table. Just give me a second and I'll build this out real quick. Just give me a second. I'm trying to build that real quick. I'm sure why it's not working now. Sorry, I hope I'm not losing you guys. I'm trying to build one real quick to give an example. Hold on, I think I'm gonna have to do it without sharing for a second so I can quickly do. Um, yeah, it's not, sorry guys, it's not working, but I don't have the luxury of time to try and figure out why it's not working, but let me explain what I'm trying to achieve. So if you can see my screen, the Excel sheet, I have a variable here, right? This is 9%. I want to see how this fee income line in 2020 will change if I change this from 9% to 8.5%. Oh, yeah. Sorry, let's look at 2021, how this will change, right? So now it's this, right, at 9%. If I change this to 8.5%, this drops to 670. If I change this to 8%, this drops to 669. If I drop this to 7.5, then if I drop this to 7, so you can see this is one variable, right? And then we can see how the revenue changes by the time I change this single variable. Can you all see my screen? Yes,
Yes, I
no?
can.
Okay, great. So just focus on this part of the screen. I'm trying to show you an example of how a sensitivity table, or why would a sensitivity table is important. So you can see that I've changed this growth rate here, right? This growth rate value of an accounting unit of RSC. I've changed it by 0.5%, right? So 0.5%, right? And then seeing how a 0.5% change in this variable has impacted the revenue, right? So you can see on your left that the impact in revenue is pretty much identical, right? So for a 0.5% change, you get a 0.979.51% change in revenue. It's like a linear change. In some instances, it's not so linear, right? Unfortunately, I don't have the time to be able to give you examples of linear versus non-linear changes or in variables, right? So I need to quickly finish up the presentation before my time runs out. So yeah, so it's the example I showed you is an example of a single variable sensitivity table. A dual sensitivity table is similar. It's just that on the X and Y axis. So with a single variable, you have on the Y axis all the variables, all the changes that you want, all the single variable that you want to change, right? And all the different values for that single variable. On the X axis, you have one single variable, and then you have only one value for that variable. In a dual variable sensitivity table, you have two variables, right? On the X and Y axis. On a Y axis, you have all the different values for that one variable. And on the X axis, you have all the different variables for the same, for a different variable. So that's the difference between a single and dual variable sensitivity, just to give you a sense of how changing two variables or one variable at a time would impact a certain outcome, right? It's typically used in valuation, hence why I have valuation multiples there. Now, moving on to sensitivity tables versus scenario analysis. A sensitivity table, the key difference between the two is that a sensitivity analysis involves changing a maximum of 2 variables simultaneously while keeping all the others the same, while a scenario analysis involves changing multiple variables simultaneously, right? So you can see in the example I have on the sheet that I'm changing. So how a sensitivity analysis work is that you have a best case, worst case, and normal case scenario, and then you have all the variables that would, all the values and all the variables that would change in each of those cases, right? I'm running short of time. I need to give enough time for questions and answers, right? So this is just an example of how a scenario analysis works. Again, this is very applicable to a bottom-up approach, right? Because a top-down approach won't have as many variables to change in the first place. So you won't have a lot in terms of the scenario analysis or sensitivity analysis. Which now says forecasting is trying to predict what will happen in the future. No, oh, sorry, I read this before. I don't know what happened. Okay. Okay, I was supposed to have a case study, but you know, we don't have enough time to go through a case study. I'll leave this time now for questions if there are any. So are there any questions for me? So we can then, this is a Q&A session now.
Hi, everyone. Please feel free to unmute your mic. You should be able to do that.
Okay, I have a question.
Yeah,
Go ahead, please.
Please, I would like to clarify. Are we going to be building some of this model, doing our analysis, or the essence of teaching us all these things, know how to use them in arriving at some of the important part of our this thing?
Okay, I'm assuming this has to do with the bootcamp, so the deliverable for the bootcamp, right?
No, I'm asking this thing that we are supposed to do, like the analysis on the company we are supposed to analyze. Are we going to be building some of these models you are teaching us for on those analyses?
I think the moderator would be better placed to answer that question. So Gloria, can you confirm? Yeah.
Okay, Abiodun will take that.
So the purpose of all this bootcamp session is actually to give you enough information. We are going to be given a target company, which you are going to analyze, and you're going to make presentation to a panel of judges. So depending on the company and depending on the sector in which that company is playing, you might need to use as many of those approaches that you are being taught that is applicable to that company. And considering that it's going to be a competitive event, the more of those analyses that are relevant that you can showcase, the more prepared you are, and the more tendency you will be the best, kind of. Let me put it that way. So the answer to it is all what you are being taught is just to give you sufficient information to be able to apply as you prepare for the competition. I don't know if that helps you.
Okay, thank you very much. I get now.
Okay, great. Questions? Any other questions?
Okay, yes, please,
Osaro has a hand raised. Please go ahead.
All right. Good morning. So I've been an insightful session so far. So I just have those two questions. My first question is as regard the sensitive analysis. So
Yes.
here is my question. Apart from the revenue growth rates, what other metrics or what other factor can be used for our sensitive analysis that will give us another clearer picture? Because sometimes I don't know if it is just these two variables So I would like to know what other options or variables we can use for our sensitive analysis, right? And also the scenario analysis, like to how much role do they play in our actual valuation? Because in most cases we have three scenario. So to what extent do they affect the valuation? Thank you.
Okay, I'll take the first question. So what variables can you use in your sensitivity analysis? The simple answer is any variable at all, right? So you can, it just depends on what the objective is, what you're trying to understand better. So I'll give an example. There was an oil and gas model company that we built a model for, and they built a sensitivity table around, I think it had something to do with the production rates from the oil reserves, right? So they built a variable. One of the variables was essentially the production rate. So there was like there were different values for the production rate, right? And they were trying to answer the question of how the level of production would impact the viability of the contract or viability of the project, right? Because there are cases where if your production rate is too low, you won't be making, you'll be falling, essentially the expenses for running that operation would exceed the income you are generating, so that the project will be run at a loss, because there are certain fixed fees that you have to pay, whether it's like operating cost or licensing fees that are fixed, whether or not you use the asset or not, you have to pay them. So that was a specific problem that they were trying to understand the minimum level of production that they need to maintain for the project to remain viable. That was the question they were trying to resolve. In other instances, you might be trying to understand, for instance, the valuation of a company, right? So in valuing a company, you might want to sensitize things like the multiple, the valuation multiple, or if you're using a DCF, the growth rates in the DCF in your DCF calculation, or the cost of capital WACC in your DCF calculation, right? You might want to sensitize those variables to see, okay, what are the range of values, equity value that I'll come up with for this company based on these changes in the variables. And the point is that what you're trying to answer, or the question you're trying to solve for, is what is the minimum value and highest value that I can negotiate, or I should expect as the equity value of this company, because that then helps you to then determine the range that you use to negotiate the price with the company, right? To say, okay, the company's equity value is usually within this range. The company's value is usually within this range, and then what does that look like? So to your question, to the first part of your question, any variable can be sensitized. Any variable can be sensitized. And to the second part of your question, which had to do with the valuation, I forget now, but I think the values that you can vary in a valuation model for your sensitivity include like the valuation multiple, the growth rate in your DCF, and the cost of capital, right? So I hope that answers your question. I'm sorry, I have literally only about 5 minutes left. So please, if anybody else has a question, you need to ask it now, because I'm going to round up the class in 5 minutes. Rashid says, when can you suggest analysts to use a Monte Carlo simulation to test the recommendations you are providing? My simple answer is, I wouldn't recommend you use a Monte Carlo simulation, because it's very, very detailed and it's very complex. So you would only use a Monte Carlo simulation if you're dealing with in a statistical analysis, or like an econometric model that is very detailed. So I wouldn't recommend that you use a Monte Carlo simulation. In determining the risk-free rate, risk premium, and beta, what is your best approach to determine those values? I think the person taking evaluation will explain this in detail, but for your risk-free rate, there are public sources of risk-free. In the CFA curriculum, there are different approaches to estimating or determine your risk-free rate. You can use, I forget the term, but essentially you can use in countries where there isn't a publicly quoted government bond, 10-year government bond, you can use the US Treasury rates and add a premium to that Treasury rate to calculate the risk-free rate for the company. The risk premium usually is tied to changes in the equity market because it's an equity risk premium. But there are cases where there are surveys or suggestions around what risk premiums will be applicable for certain countries, right? But the beta is also changes in the price. Usually, beta is quoted on data vendors like Bloomberg, Reuters, etc. Right? So those are public sources for getting those values. And the CFA curriculum also give you other approaches in terms of how you can also calculate these things if the public sources are not available. But I would recommend getting this from the sources.
Precious hand has been up for a while. Maybe
yeah, Precious, you need to go ahead to ask your question. Precious.
Okay, she just unmuted. Maybe her network is bad. Precious, can you hear us?
Okay, I can't hear Precious. If she can hear us, she should type a question, but I'm only taking 2 more questions. I need to go now. I'm taking Olamilekan's question, and then Precious, if she can hear us. Olamilekan says, so as some of us are participating in the challenge, some are new to carrying out analysis. I hope we can get a live practical case study training from start to finish, sir. Unfortunately, you can't get a live practical case study training from me, and I'm sure the moderator will give you a better explanation.
Okay, so let me answer that. So we are going to be assigning you to some tutors or mentors. So those mentors are going to work closely with you to give you some practical information in real life cases. I hope that answers your question.
Okay.
Says yes.
Okay.
Precious, are you able to type your question, or can you talk now quickly?
Okay, I can't hear Precious, so I take it that she's not online. I need to rush now. It's been a pleasure to speak with every one of you. Thank you so much for your questions and your analysis. I'll send the materials over after this class. You should get it early next week. I just want to clean it up a little bit, and then maybe add a few things that might be relevant based on the questions that have been asked. But thank you for your time. Thank you for the opportunity, and do have a great day.
Okay, Moyo sir, thank you so much for giving us your time today. On behalf of the CFA Society Nigeria, I want to say thank you to you, and we appreciate this time. And essentially, we are grateful, and we hope that we'll still have more of you again and again in subsequent editions. Thank you so much.
Thank you. We look forward to it. Thank you. Bye.
Bye. So that will be all for today. Thank you everyone for joining. I believe that you've had a great time learning about this. We started this last week where we had the session with another facilitator. So we are still going to be rolling a couple of support to you ahead of the research challenge. And we just wish you all the best. If you have any further question, please feel free to reach any of us, Gloria, or any member of the team as well, so that we could be able to answer your questions. So thank you everyone for joining, and that will be all for today. Thank you so much.
If you've made a decision to aim for a long-term and successful finance career, taking the Chartered Financial Analyst CFA exam and studying the curriculum is an excellent way to ensure you have a strong knowledge base and top-notch skills. Are you ready to take the bold step to invest in yourself? CFA Society Nigeria is at your disposal, promoting the highest standards of investment practice in Nigeria. As an affiliate of CFA Institute, CFA Society Nigeria seeks to promote the highest standards of investment practice in Nigeria and to provide a vibrant community in which its members and other key players in the investment industry can interact and grow. When you have the CFA charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietynG.org. CFA Society Nigeria, making finance